Hello everyone, welcome back to another Lunch and Learn webinar. I'm your host, Mayur Thaker. I am an equity strategist here at Zacks Professional Services. And this is a important update to my ongoing series of macro discussions and analysis on where I believe the macroeconomy is headed and what the leading indicators of that are telling us and what the implications of that are on earnings for S&P 500 companies, and therefore on the market index itself, on the direction of stock prices. And again, this is a ongoing theme that I've been working on for the past year, slightly over a year now. And I continue to, as far as the data is concerned, continue to believe that the leading indicators of economic cycles continue to point to recession. And so we've got a lot to unpack here, several updates, and a couple of new things here as well in today's webinar. And so I'm excited to talk about that with you and share with you what I have found. So let's get started with all that. So here's a quick synopsis on why I believe we are entering recession. These are the broad categories of data points that I'm seeing that are suggesting all of that. And so if you look at a aggregation of manufacturing indices, these indexes have been in recession for 12 to 14 months. Out of the past 15 months, we just had one, indicator, jump up into expansion just yesterday. That's the Chicago PMI. And so that's been a refreshing change of pace here. We'll see if that turns into a trend, but so far it has not, caught on with the other manufacturing gauges just yet. So I continue to believe that the manufacturing gauges remain in recession. We also have the inverted yield curve. A lot has been talked about that. I believe, this time is no different from past recessions. Everybody believes that this time is different, that the yield curve is communicating something differently this time versus in the past. I think it's the same principle over and over again. Remember, every time that the 10-year yield minus the 2-year yield has inverted, we have entered recession in the following 18 to 36 months. 36 months on the high end, but on average it's just right around 2 years as a lead time. So we are well into that. We're approaching that 2-year anniversary in the next couple of months here. So I believe that the inverted yield curve continues to point towards recession as well. We also have the Conference Board, which publishes their leading economic index. That's been in contraction for actually 19 months now. So this is a typo on my screen. It says 18, but it's actually 19. It's been a long time that that index has been in contraction for this long, and yet we have avoided recession. I don't believe that's ever happened in the history of that index. So we're now at 19 consecutive months of contraction, well within the ranges that are typical for recession. I also like to focus on excess savings. This is now well below trend and forecasted to be depleted by the first half of next year. This is important for retail sales, which is the bread and butter of the U.S. economy. So far, retail sales have been okay. It's been sluggish, even if you adjust for inflation. We'll take a look at that. But on a nominal basis, it's been doing okay, and this is because consumers have been spending more. So real disposable consumption, or real consumption has outpaced real disposable income. And that is leading to a drawdown of excess savings. We'll take a look at a couple of those charts here. So I believe that these excess savings are what has kept the retail sales, afloat for, this time so far. But if the current trend continues, excess savings will be depleted by the first half of next year. And so we are well within the range that markets start to price in a significant contraction in retail sales. Cyclical GDP, this is also very important. This is a leading indicator of GDP, which is the aggregate number that gets all the headlines and all the press. This is now entering contraction, and real GDI is also already in contraction. We'll take a look at that as well. These are important leading indicators for GDP itself. And then employment, leading indicators of employment, they are approaching contraction, not yet in contraction. But you'll see that, I believe that, along the lines of, the excess savings, flipping into contraction by the first half of next year, I believe employment will also, the leading indicators of employment, cyclical employment, will also enter contraction at some point in the first half of next year. Again, this is, just not very long from now. This is only about a 6 to 7 month time frame. And again, typically if, the markets get a hint of this, they start to price in those types of things right around now. And I'm actually a little surprised that they haven't just yet, but I believe that there is real risk that that's what's going to happen. And then lastly, credit contraction. We see that doesn't typically happen outside of recessions, where banks taper credit, where banks report rising loan loss provisions to high enough levels, where banks report tightening credit standards and rising credit card delinquencies. So this is all happening within the area of credit contraction. And then lastly, unlike past market environments, the Fed is not supportive of stocks or bonds right now, and won't be until we see a sizable decline. That's the key differentiator between now and past environments where the Fed has been ready to step in to support the economy with monetary policy actions. It's quite the opposite this time around. So here we have 10-year real yields. This is also very important because this is also exerting a toll on the economy. When the cost of capital has risen to 15 plus year highs, approaching 20-year highs, this is a real, showstopper when it comes to economic growth at the margin, because now the hurdle rate is much higher. So, companies are now forced to reevaluate their, business decisions, and investors are forced to reevaluate whether they want to take risk in stocks or whether they're comfortable earning a, essentially a guaranteed 2% real return on the 10-year Treasury bond right now. So with higher real yields come increasing headwinds when it comes to earnings growth and economic growth. Why? Because the hurdle rate is much higher. This is the rate that all business decisions are compared against. This is the benchmark for making economic decisions. So companies will stop and ask, before we make this investment in this factory or this new project, does it yield a return on capital that is above, the 10-year real yield? Is the real ROI on our CapEx greater than the real yield on 10-year treasuries? And if the answer is no, then it does not add value. It does not add economic value. And it's better for companies to then simply return capital to shareholders rather than to invest in growth. So remember, when that happens, when CapEx is scrapped, when those plans are scrapped, that is someone else's revenue that is disappearing. So again, this has a lagged effect on economic growth, but this is one of the major reasons why I believe that we are going to be entering recession, and that is because the Fed has, really driven up the cost of capital while the rate of inflation has been falling at the same time. This is one of the reasons why we're seeing weakness in all of these sectors that I just mentioned. The first of which is manufacturing. Here we can see the ISM manufacturing. We just got an update on this this morning. Today is December 1st as of this recording, and it was unchanged at 46.7. So this is a multi-month contraction now, dating back to 2022. So ISM has now been in contraction for 13 consecutive months. And here's a zoomed in look of this. And what I've done here, as you notice, is that the orange line represents the S&P earnings growth year over year, forward expectations for earnings growth year over year. And as you can see, it tracks ISM manufacturing quite well. But you can see a curious divergence happening just recently here, where we see ISM back into contraction, and yet the S&P earnings growth expectations have been accelerating. I believe that is not going to continue. Ultimately, one of these two have to give. Either we see a bounce back in ISM manufacturing PMIs, or we see a downturn in earnings expectations. I believe it's going to be the latter because we just got another update on this morning. So this is 13 consecutive months of decline. If we get another month or two of a contracting ISM, I believe that it's inevitable that earnings estimates are going to be slashed because these are the leading indicators of earnings for the S&P. And this is in part driven by the new orders subcomponent. You can see that this has been in contraction now for 14 months. This is the proxy for industrial demand, and it continues to remain sluggish, and it's firmly at recessionary levels. We typically don't see this index at these depressed levels outside of recessions, as you can see on this chart. Chicago PMI, this actually had a great bounce back yesterday. Chicago PMI jumped from 44 all the way to 55, which is the first expansionary month that we've seen in the last 13 months. So now we have 12 out of the last 13 months of contraction, but the latest reading for November was very bullish. So let's see if that continues. But as of today, the day after the Chicago PMI, ISM did not confirm the Chicago PMI. So there could be a little funky one-off that happened specifically within the Rust Belt that the Chicago PMI tracks more closely than the ISM, which is more of a national manufacturing gauge. So we'll see if that is a one-off or if it actually signals a rebound in manufacturing. But my bet is that it's not. It's going to be a one-off, but we will see with that. Again, because several of the other indexes remain in contraction here. We can see the Philadelphia Fed index, again, that's been in contraction, and we've never seen a time where it's fallen below minus 25 and we've avoided recession. That's never happened in the 60 years that this index has been running. Factories continue to cut work week hours as orders fall. You can see this number is continuously coming down. We typically don't see the work week this short outside of recessions. Again, just one, more indicators out of many others that is pointing towards a economic downturn. The inverted yield curve, we know about this. This is quite widely published. This is now deeply in contraction now for over almost 2 years now, and this remains in inversion. We have seen intense steepening since September, but it has since backed off. I would keep a very close watch on this because remember, when something becomes imminent, when there is about to be a burst of volatility, we see this spread go from inversion to then re-steepening, as you can see here. So the inversion happens well before the recession, and then when we see the re-steepening, that is the signal that something is about to happen. As you can see here, the inversion happened, and then the re-steepening happened right before the recession became imminent. So if we see a re-steepening above zero, that to me tells me that there will be a imminent recession. As you can see in the past 3 times that this has happened. The prior inversion, and then therefore the re-steepening above the zero line. The re-steepening is really the final warning shot that you typically get right before a recession is about to be imminently beginning. So we've started to see some re-steepening here. We're still in an inversion, but I would keep a very close watch on this to get a hint of when something is about to be very imminent. But as we can see here, history has shown that a forced inversion breaks things. This is the Fed funds rate minus the 2-year yield. And whenever this number goes into inversion, it means that the Fed is being excessively restrictive. Remember, the 2-year yield is also a fairly short-term interest rate. But because it's not directly controlled by the Fed, there's some semblance of market forces that determine this yield. And so whenever this number, whenever the spread between this gets inverted, it means that the Fed is forcing excessive tightness beyond what the market wants for healthy, economic expansion. And the Fed has its own reasons of doing this. I believe that the Fed has been overly restrictive just because I believe that the economy is heading into recession. But as you can see here, this number continues to be inverted, and it means that the Fed is being more restrictive than what the marketplace wants them to be, in my view. This is just my interpretation of it. But as you can see here, every time that this number has gotten inverted, that has typically led to a disorderly breakdown of something or someone or a group of things. Like in 2008, banks went under. In 2000, we had a very high level of bankruptcies and delinquencies. I believe that same thing is happening here today. So again, history typically doesn't repeat, but it does rhyme. And I don't believe this time is any different. Now, recessionary forces traditionally drive long-term yields lower, but we do have huge U.S. Treasury issuance. Some 30% of all U.S. government debt outstanding is set to mature in the next 6 to 12 months. At the same time, the federal government is in a deep fiscal deficit of $2 trillion. So this kind of creates a debt spiral of deepening deficits due to borrowing at increasing interest rates. So again, as these treasuries mature, the government's going to have to refinance these, and rates are much higher today than they were back when those bonds were first issued, some 10 years ago. So this is going to lead to soaring interest expenses and therefore soaring deficits. So it's kind of a negative feedback loop, sort of a debt spiral, if you will, where higher borrowing costs lead to higher deficits lead to higher interest rates therefore lead to higher borrowing costs, and therefore that's a vicious cycle that really doesn't end. At the same time, the Fed is remaining steadfast at keeping rates higher for longer. This means that we're going to have true price discovery in the bond market, and that's what we've been seeing these past couple of months as the 10-year Treasury, touched 5%. It's since backed off, but it's still an important market to keep a very close watch on. Typically, I would be a buyer of Treasuries, but this is a different environment because of these, three factors. That's quite different from past environments. So my view is that we will eventually have lower rates, but we could be in for higher rates during the intermediate term before investors really reach for safety and therefore drive yields lower. The leading economic index, this is again published by the Conference Board. This has now been in decline for 19 consecutive months. It's firmly at recessionary levels, and it's led by a weakening credit growth and manufacturing new orders. Again, we've never seen 19 consecutive months of contraction without being in recession. So this time I don't believe is any different. Now we have excess savings. This is two charts published by the San Francisco Fed. So far, real personal consumption has outpaced real personal income, which is why retail sales on a nominal basis have been doing quite okay. Consumers are still spending. Consumers are still going on vacations. Consumers are still going on cruises and buying airfare and booking hotel stays. And it's because consumption continues to outpace income, which means that consumers have chosen to draw down these excess pandemic level savings. Remember, we saw this huge surge in savings, in aggregate savings, because of the stimulus checks, because of the moratoriums on rent, or on the moratoriums on expelling folks from apartments during the pandemic. A lot of people saved money because they didn't have to pay rent for some time in many municipalities throughout the country. So we had a huge boom in excess savings. Part of that was driven by the stock market bubble that leads to the wealth effect as well. So savings really ballooned in the post-COVID aftermath. And what has happened since then is that consumers have really chosen to spend a lot more than they earn, which means that they've been drawing down their excess savings. And if you were to continue this number, if you were to continue this trend here, then it basically lends us to estimate that these excess savings will now be fully depleted at some point in the first half of 2024. So it's more than what the previous estimate was, but it doesn't give us too much more of an extension of time. This number should most likely be drawdown by the first half of next year. So, and as you can see here on the chart to the right, personal savings is now well below trend. As you can see here, this was the pre-pandemic trend growth in personal savings. We're now well below that and heading lower. So again, this is not sustainable. Consumption outpacing income is not sustainable forever. So while retail sales have been okay, while the data on travel and leisure have been robust, while Black Friday sales have been robust, I don't believe that this is sustainable as long as consumption outpaces income, and therefore, as long as consumers continue to draw down their excess pandemic savings, that can only last for so long. And I believe that the clock is going to run out, again in the first half of next year. Now let's look at GDP. Now a lot has been said about GDP. We got a blazing hot 5.2% GDP print quarter over quarter. I've shown a chart here that looks at year over year instead. That number again is very strong, still at just under 2% real GDP growth year over year. But look at what I've done here. I want to present a concept. This is something new that I've done for this presentation. I want to bring forward a concept that looks at subcomponents of real GDP. And remember, GDP is an aggregate of many different things. We have real personal consumption expenditures, PCE. We have investment, so that's business investments of all sorts. We have government spending, and then we have exports and imports. What I want to do here is strip out the non-core, non-cyclical elements of what I just said there and look at purely the cyclical elements of GDP. Why? Because as you can see here, when you look at those cyclical components of GDP, even though there's a lot more volatility here, what this tells you is that whenever that number drops below zero, that's typically when we have recessions. And as you can see here, you get a much greater lead time in warning that a recession is imminent or is coming. As you can see here, this number went bearish, it went below zero in 2007. That gave you almost a year advance notice before things really fell apart in 2008. And again, that happened in 2020, but we saw a strong rally, after that. But here now, we are once again in contraction within the cyclical components of GDP. And I'll tell you exactly what's in them in that index. But if you this is a important conceptual sort of exercise, because why would you focus on government spend or government spending, for example, or healthcare or education? Because those sectors are not cyclical. They continue to grow outside of business cycles. So when you remove those non-cyclical components of GDP, then that gives you a remainder which is actually susceptible to the business cycle. And that tells you where the business cycle essentially is at. And it also gives you a leading indicator of where the aggregate real GDP figure will come in. So this has now been in contraction for just about a year. So this is why I believe that it's, we are, in the late innings of a recession beginning, unless if these numbers turn back up. And I believe that the data is suggesting that real GDP will follow cyclical real GDP. And as you can see here, I'm just showing you this in dollar terms. This is actually indexed to 100, based on 2017 levels. But as you can see here, we're now well below trend for the past 12 years. Whereas real GDP, this is what you would see quoted throughout financial media, it's well above trend, right? But if you look at the leading indicator of real GDP, we're below trend and have been so for just about a year now. So this is, again, a leading indicator to real GDP. I believe that the longer we remain below trend, the longer we remain in contraction year over year, the sooner you're going to see real GDP roll over, unless governments step up in a big way and start new spending. That would be one way that real GDP would continue to avoid recession, even with cyclical GDP in recession. But I don't see that happening now, specifically, especially with a Republican-controlled House. I don't think that that's going to be happening anytime soon. Here are some of the subcomponents that I'd like to look at. But gross domestic income, this is another figure that goes grossly overlooked. But that one just was released last week, and despite 3% GDP growth quarter over quarter, or year over year, I should say, real GDI was down minus 0.2%. So we're now 4 quarters of essentially zero to negative growth by GDI. And remember, GDI is the statistical equivalent to GDP, and yet GDI is negative, in the most recent quarter. So something is not adding up here. I really got to say. But cyclical GDP, as I just mentioned, that's the summation of durable goods, business equipment investment, and residential investment. So if you were to take these three and sum them up and look at the percentage change year over year, these are the more susceptible industries or sectors or components of GDP that respond to actual business cycles. So cyclical GDP is in contraction. Real GDI is not at all confirming these robust real GDP figures. I believe that real GDP is dangerously at risk of falling apart in the next, in the next quarter, maybe 2 quarters, but I believe at some point in the first half of next year. So all these various different items seem to be lining up that, recession may be confirmed at some point in the first half of next year. So here again is a highlighting of how GDI and GDP are very closely correlated. As you can see here, there's really never a difference, a big difference between the two. But look at the variation that we are seeing now. The year-over-year change in real GDP versus the real year-over-year change in real GDI. It's been, a divergence, a notable divergence. And I believe that this cannot last. This type of divergence really cannot last. And look at the ratio of the two. As you can see here, this is a ratio of real GDI to real GDP. And typically, when do you see the number contract? It's usually in and around recessions, as we saw in 2020 and in 2008. That number went below 1 in advance of the recession. And that's where we're at right now. So again, yet another figure. Here's another figure, GDP plus. This is an enhanced version of the GDP. This is published by the Philly Fed. And even that figure is nowhere close to what we're seeing in real GDP. Still much better than GDI, but again, the growth rates that we're seeing in GDP are not as strong as what they look like as published by the headline GDP figure. Let's look at employment now. So the same thing that we just did with GDP, we can do with employment. So now we're looking at cyclical employment. Okay, so we take a look at the monthly jobs report that we get from the BLS, and what I like to do is compare the aggregate payrolls, right, which is the headline number. The change in that number gives you the establishment survey, non-farm payroll growth every month. That's the number that we see quoted in the financial media. What I like to do is take out several components of that which are cyclical in nature. Because remember, the job market is a function of multiple sectors of which government, education, and healthcare are included. And remember, government, education, and healthcare are not very sensitive to the business cycle. And so it does not offer, important information when it comes to putting your pulse on the state of the business cycle that we're in. So if you focus in on the areas of or the sectors of employment that are cyclical in nature, such as wholesale trade, such as building material stores, such as truck transportation, such as real estate, such as professional and business services jobs, such as commercial banking, such as transportation equipment manufacturing, other miscellaneous manufacturing jobs. If you look at those sectors, you can see, and if you aggregate them up, you'll see that this is the result. As you can see here, this chart, typically the cyclical employment index that I've created here typically goes bearish, meaning in contraction, in advance of the headline number going into contraction. And the lead time there is a good 6 months. It's hard to see here, but you can see that number there is roughly 4 to 6 months of lead time. And that number has not yet went into contraction, but like I've been saying with the other factors here, I believe that that's going to happen sometime in the first half of next year. In fact, I believe that this number will actually go into contraction in advance of that. I believe that could happen in January or February. So, most likely in the first quarter of next year, not even just the first half of next year. So, again, the cyclical employment index that I built here gives you a lead time on the direction in which aggregate employment is headed. And, whenever this number goes negative, that's been a surefire confirmation that we are in recession, as we can see, during the last 3 times, during the early 1990 recession, the 2000 recession, and the 2008 recession, as well as the COVID recession. That didn't give us any lead time because of the shock of COVID, but now we're seeing this much gradually come down with plenty of reaction time for us to decide. So we will keep a close eye on this one, and I will be sure to report, updates on this as we, do more of these webinars in the future. But I believe that the rate of change is very clear. The direction is very clear. The trend is very clear that this is headed down and, may enter contraction by the first quarter of 2024. So again, cyclical employment is a measure of the total labor force working in sectors outside of government, education, and healthcare. I laid out those specific sectors just recently here, just now. It's very important to make this distinction for analytical purposes to understand where job gains are coming from. Is it coming from government or is it coming from the private sector? So the declining cyclical employment is more of a direct reflection of the job situation in the real world. And that is the leading indicator for aggregate employment growth. This temporary help services is one example of that. So I've already counted it within my cyclical employment index, but this is a great example of a direct, index or, sector from the jobs report that starts to turn well in advance of recessions. And as you can see, it turned in advance of the 2008 recession. It turned in advance of the 2000 recession. It turned in advance of the 1990 recession, and it's turning right now. So unless if you are confidently saying that this time is different, this is most likely a leading indication of an oncoming recession. This is the permanent job losers subsection of the monthly NFP report. And this is a different way of looking at it. But whenever this number crosses above the 2-year moving average, we've been in a confirmed recession. And it has just fallen short of that by about 20,000 jobs versus the 1.605 million permanent job losers reported. So just 20K, that's less than 0.1%. So most likely, unless if we see a downtick next month, it's most likely that we are going to see a confirmation of a crossover there versus the 2-year moving average when we get the November NFP jobs report, next week. Continuing claims, this number hasn't yet crossed over the 2-year moving average, but it is clearly trending up and has now hit a 2-year high. Again, another confirmation that the job situation is weakening. Again, lending credibility to the recession thesis. Now, analysts are still expecting 12% earnings growth next year, but I believe all of these leading indicators are suggesting that these expectations are vastly overstated. And I want to emphasize that word, vastly. I believe that these numbers, these expectations for earnings, are going to come down significantly in the coming months. And this is going to be because of the rising cost of capital that will inevitably lead to rising delinquencies, defaults, bankruptcies, and ultimately job cuts, as we are already starting to see. So again, recessions are always a slow buildup of many things. But, again, if we see a rapidly steepening yield curve, this may be the sign that something is about to happen, that someone is being caught offsides, a major bank or somebody out there is susceptible to or vulnerable to an area of the economy that is experiencing a major downturn, such as commercial real estate, for example. Banks continue to face a lot of difficulty. They have massive losses, unrealized losses on their held-to-maturity securities. They continue to see depositor withdrawals. We continue to see declining commercial real estate prices and rising loan loss provisions as a result of all this, and therefore, banks as a whole are tightening credit availability. Remember, credit availability is the lifeblood of economic expansion and S&P earning growth. Again, at the margin, this is telling me that we are going to see a substantial decline in earnings estimates for next year from where they are today. Here we can see a chart of that. This is the total deposits being withdrawn, loan loss provisions rising. Again, net result is tightening credit availability. Again, you can see on this chart very closely, when do banks tighten credit standards to this extent? It's usually in and around recessions. As you can see on the chart, 2008 was the last time this happened, or 2020, as well as 2000. Very clear. So analysts are already on the ball when it comes to cutting regional bank earnings forecasts. So I believe that typically we don't see a strong bull market when regional banks are suffering like this. So again, regional bank situation is, I believe, a leading indicator for aggregate S&P earnings this time around. So I don't believe that the banking crisis is over yet. ISM backlog, this continues to telegraph a drop in CPI. So I believe that the CPI as well as core CPI will continue to come down, as we've seen. Again, the Fed has been removing liquidity. That's been sort of the driving force behind all this happening. M2 money stock is negative year over year for the first time ever in recorded history. Again, housing prices are under deep pressure, as they should be, as mortgage rates have soared. This is also weighing quite heavily on commercial real estate. So, I believe that, earnings for home builders are at risk significantly as we see declining volumes here. Even if prices don't necessarily come down quick enough, we will be seeing declining volume, and that's what we're already starting to see here. Real retail sales. So retail sales on a nominal basis are doing quite well, but if you adjust it for inflation, this number is negative now for 8 consecutive months now, not just 7, but 8 as of the most recent data. And this is all despite unemployment being very low. And as you saw on the employment charts here, the leading indicators of employment are pointing to increasing joblessness. So I believe that the unemployment rate is getting ready to rise. At the margin, that's going to be bearish for earnings growth expectations. Meanwhile, the BLS is revised lower the NFP number every single month through August this year by a total of 16% year to date. That's quite a significant negative revision. That typically doesn't happen outside recessions. So again, what does all this imply for stocks? Again, I believe that stocks are substantially overvalued given the direction of the economy heading towards recession. PEs are very stretched right now, approaching 19 to 20. That's much higher than previous 5% interest rate environments on lower earnings growth expectations. And yet now, investors are going to be given a wide variety of options that are an alternative to stocks. As you see here, the 1-year Treasury yield, comfortably surpasses the S&P free cash flow yield by basically the largest margin since 2007. So at the margin, owning stocks is quite risky. This is an anecdote from the ISM Manufacturing Survey. Again, they are reporting concerns relative to the slowing economy and sluggish demand. FedEx has been warning about this since Q1 of this year. Maersk, actually, their shares dropped 18% after reporting Q3 earnings. They continue to forecast significant demand challenges, significant drop-off in shipping volumes. This is, again, a direct reflection on global trade, which, again, is an indictment on economic growth expectations. American Express is reporting increasing provisions for bad loans, and it's now at levels consistent with recession. Now, you can see here that, the loan loss provisions for American Express are basically matching where they were, during the COVID disruption and where they were during 2008. So again, yet another indication that, private sector companies are starting to see the consumer crack with rising delinquencies, rising default rates. And this is only going to worsen as employment starts to deteriorate. So, putting all this together, discounted earnings model within our Zacks research system framework suggests that the S&P is overvalued by 20%. I continue to believe that, 31 to 3,200 on the S&P is likely. This is a substantial drop from today's levels. I understand that it's a quite bold call to make, but I continue to stand by it as long as the leading indicators for economic growth and S&P earnings continue to point towards contraction. I continue to believe that stocks are overvalued at a PE of 20, as well as a elevated Schiller PE, which forecasts forward 5-year returns may be very lackluster from today's levels. So my conclusions are basically that the direction of leading fundamental indicators at the margin implies negative pressure to S&P earnings. This means that analysts they will mark down both this year and next year earnings forecasts. At the same time, markets are priced for earnings growth at a forward PE of 18 to 20 times right now. If that doesn't happen, if we don't get that earnings growth expectation that analysts currently have, I believe that there's going to be a substantial drawdown. And I believe that this drawdown has already begun. Remember, stocks, even though they're up this year, we're still, at flat returns over the past 2 years now. We've had 2 years of essentially zero returns, slightly negative returns. So I believe that this rally that we're seeing in the S&P continues to be a bear market rally. And I believe that these stock prices are headed quite lower in the coming months here. So again, my ideal capital allocation, again, stick to short-term treasuries, stick to high-quality investment-grade short-term corporate bonds, and then stick to recession-resistant equities. That is the earning certain portfolio that we maintain here at Zacks. Focus on the companies with low beta, dividend growth or share buybacks, and a low Shiller PE. I would focus on that area of the portfolio. So again, these are the types of companies we own: recession-resistant, high-quality, durable businesses that have withstood the test of time. Here you can see the earnings growth of these types of companies, rock solid even through recessions. So again, hope you found this helpful. I'd love to hear feedback from you if you have any questions about any of these charts, or if there's a topic that you'd like me to discuss in a future webinar. Please do reach out to us at info@zackspro.com, or you can reach out to us at strategycall@zackspro.com, or reach us at our number here at 1-866-794-6065. All right, everybody, take care and hope to see you on the next one. Bye-bye.